So you want to buy a skyscraper? Sure. You've got the money. You've done the supercar thing. You've done the yacht thing. And now you're sitting in a meeting with a wealth manager who used the phrase real asset diversification. And somehow that felt exciting. So here we are. Let's start with the price list. Because unlike your other hobbies, this one has a surprisingly wide range. From mildly offensive to, I need to restructure 3 offshore entities just to wire the deposit. At the entry level, you've got a luxury condo, Miami, Manhattan, maybe a floor-through in London's Mayfair. You're looking at $2 million to $15 million, depending on the view and how recently someone famous lived there. This is the Toyota Camry of trophy real estate. Respectable, boring. Every hedge fund associate owns one. Step up and you're buying a penthouse. Same buildings, top floor, private elevator, terrace you never use. Price range $20 million to $200 million. The record was the penthouse at 220 Central Park South in Manhattan, sold in 2019 to Ken Griffin, the Citadel founder, for $238 million. He already had 3 other homes in Chicago, Palm Beach, and London. The New York one was apparently for guests. Next tier, you buy the whole building, not a unit, the asset itself. A Class A residential tower in a major market runs $50 million to $500 million depending on the city, the lease rolls, and whether the seller is distressed. At this level, you stop being a resident and start being a landlord. Congratulations! You now have 200 strangers emailing you about broken dishwashers. Above that is the city block, a mixed-use development play where you own the land, the commercial podium, the residential tower, and the retail beneath it. These deals start around $300 million and go up to $2 billion. You'll need an army of lawyers, a Cayman Islands holding company, and a very patient construction lender. And at the top of the pyramid, the thing that the truly deranged actually do is building a re-IT empire. A real estate investment trust that you either take public or operate privately, controlling billions in property across multiple cities, asset classes, and jurisdictions. Blackstone's real estate arm manages $330 billion. Not worth $330 billion manages it. The distinction matters, and we'll get to that. You don't just wire money to a seller. Nobody at this level does. There are 3 real methods. The first is the direct acquisition through an LLC stack. You create a Delaware holding company, which owns a series of single-purpose LLCs, each of which owns one property. Why? Liability isolation. If your building in Chicago has a slip-and-fall lawsuit that goes nuclear, the plaintiff can only reach that one LLC, not your London penthouse, not your Cayman-held Midtown tower. This is standard. Your lawyer will set it up for $15,000 in legal fees, and the accountant will charge you $40,000 a year to maintain the structure. Consider it a cost of doing business. The second method is debt leverage. Here's the part the wealthy don't advertise. Almost nobody buys real estate with cash. You put down 20% to 30% and borrow the rest from a bank, usually a commercial mortgage at 5% to 7% interest in the current rate environment. Why? Because if you buy a $100 million building with $30 million down and it appreciates 10%, you made $10 million on a $30 million investment. That's a 33% return. If you'd paid cash, it's a 10% return. Leverage amplifies everything, gains and losses equally, which is the part we'll revisit later. The third method is the one that sounds genius until it isn't. The 1031 exchange. Under US tax law, if you sell an investment property and reinvest the proceeds into another one within 180 days, you defer, not eliminate, defer the capital gains tax. Some investors have been rolling 1030 exchanges since the 1980s, turning $5 million starter properties into $500 million portfolios without ever paying capital gains. Theoretically, if you die holding the property, the cost basis resets and the deferred tax disappears entirely. It's called the step-up in basis, and it is, at the moment, still legal. Congress has tried to close it 7 times. It keeps surviving. There's one catch with leverage, though, and it's not a small one. We'll get to it. You've bought your building. Let's say a Class A residential tower in Manhattan. $200 million, 30% down, $140 million in financing at 6.5% interest. You are now the proud owner of a beautiful, money-consuming machine. Day 1, 19,178. That is what it costs you to own this building every single day before a single unit generates $1 of rent. Where does that number come from? Property taxes in New York City run roughly 1% of assessed value per year on commercial and residential income properties. On a $200 million asset, that's $2 million per year, $5,179 a day. And that's if the city doesn't reassess upward, which it will. Debt service on that $140 million mortgage at 6.5% over 30 years is approximately $885,000 a month, $29,500 a day. That payment happens whether your building is full or empty. Building management and staff. A full-service luxury tower needs a property management firm, typically 5% to 8% of gross rents, a doorman staff, a super maintenance crew, and a building manager. Budget $1.2 million a year, $3,288 a day, door insurance. A $200 million residential tower in Manhattan carries a commercial property insurance policy that runs between $1.5 million and $3 million per year depending on flood zone, claims history, and whether your insurer has had a bad quarter in Florida. Call it $2,005,179 a day. Capital expenditure reserves. Elevators fail. Roofs leak. HVAC systems that were installed in 2008 do not last forever. Industry standard is to reserve 10% to 15% of gross revenue for CapEx on a $200 million asset generating $8 million in annual rent. That's $800,000 to $1.2 million sitting in escrow for future repairs. $2,740 a day that you can't touch. Add it up. You're burning approximately $7 million a year before financing costs and $10.6 million annually in debt service on top of that. Total carrying cost, $17.6 million per year, $48,219 a day, and this is with 100% occupancy. The moment your building goes to 80% occupied, which is a perfectly normal vacancy rate in a slow market, your revenue drops, but your costs don't move. Not a single dollar. Now remember that bankruptcy deal I mentioned? Some of the most attractive distressed real estate deals in 2024 were office towers in San Francisco being sold for 60% below their 2019 valuations. Buyers thought they were getting a deal. What they were actually buying was a building with 40% vacancy, a $50 million deferred maintenance backlog, and tenants with leases expiring in 18 months who were already in negotiations with WeWork for space across the street. A discount is not a deal. A discount is a question. There are 2 ways real estate makes you money, and most amateur investors confuse them. The first is appreciation. The building is worth more tomorrow than it is today. This is what 90% of people are actually betting on when they buy property. It's real. It's happened historically, and it is entirely outside your control. The second is cash flow. The building generates more rent than it costs to own. This is what professional investors actually care about, and the number that determines whether a building generates cash flow is called the cap rate. Cap rate is simple. Take the building's annual net operating income, gross rents minus operating expenses, but before debt service, and divide it by the purchase price. A $200 million building generating $8 million in net operating income has a 4% cap rate. In 2021, luxury residential cap rates in Manhattan were running 2.5% to 3%, meaning investors were paying $200 million for buildings generating $5 million in an NOI. They were banking entirely on appreciation and the ability to refinance at low interest rates forever. Then, the Fed raised rates 11 times between March 2022 and July 2023. Suddenly, a 3% cap rate building financed at 6.5%. Interest is cash flow negative from day one. You're borrowing money at 6.5% to buy an asset yielding 3%. The only way this works is if the asset keeps appreciating fast enough to outrun the bleed. The secret that the genuinely wealthy use instead is the NNN lease triple net. You buy a commercial property, lease it to a single creditworthy tenant, a CVS, a Starbucks, a bank branch, on a 15 to 20-year lease where the tenant pays the property taxes, the insurance, and the maintenance. Your only job is to cash the check. Cap rates on NNN leases run 4.5% to 6.5%. Not spectacular, but the cash flow is predictable. The management headaches are minimal, and you can own 40 of them across the country without a single employee. This is what wealthy families actually do. The flashy penthouse is the ego buy. The strip mall with a 20-year McDonald's lease is the actual wealth builder. Harry McClough is a New York developer who, in February 2007, 7 months before the financial system began its visible collapse, bought 7 Midtown Manhattan office towers from Equity Office Properties for $7 billion. He put down $50 million of his own money and financed the rest with short-term debt, assuming he'd refinance once he'd repositioned the assets. By 2008, the credit markets were frozen. His lender, Deutsche Bank, called the loans. McClough was forced to hand back all 7 buildings and sell the GM building, his flagship asset, the one he'd owned for years, to a Boston Properties consortium for $2.8 billion just to cover his debts. He lost essentially everything he'd built over decades in about 18 months. The lesson isn't that McClough was reckless exactly. The lesson is that at $7 billion in short-term leverage, the timing window for being wrong is measured in weeks, not years. The second story is Evergrande, China's largest real estate developer, which at its peak was worth $50 billion and had pre-sold apartments to over 1.5 million people, apartments that did not yet exist. Evergrande built its empire almost entirely on pre-sale deposits and short-term debt, accumulating $300 billion in liabilities by 2021. When Beijing tightened lending rules for developers, the music stopped. Construction halted on hundreds of projects. Homebuyers who'd made deposits on unbuilt units organized protests. By 2023, a Hong Kong court ordered the company liquidated. Those 1.5 million people are still waiting for their apartments. The third story is quieter, but possibly more instructive. In 2006, Chorus Bank in Chicago had built a $5 billion portfolio of construction loans for luxury condo towers in Miami, Atlanta, and Las Vegas, markets that were, at the time, experiencing once-in-a-generation demand. By 2009, condo prices in Miami had dropped 50%. Chorus failed. The FDIC took over and sold the loan portfolio to a private equity consortium for $2.77 billion 55 cents on the dollar. Those luxury towers were completed and sold at a fraction of their projected prices, wiping out the original developers entirely. The thing all 3 stories have in common: short-term debt financing long-term assets in a market that turned, right now, In mid-2025, the commercial real estate market is living through what analysts are calling a slow-motion reset. Office vacancy rates in San Francisco are above 35%. In Chicago, above 25%. In Manhattan, stabilizing around 18%, which is still the highest it's been since the early 1990s recession. The cause is not a mystery. Remote work permanently reduced demand for office space, and $1.5 trillion in commercial real estate loans originated at low rates between 2019 and 2022 are now coming due at a moment when refinancing at current rates would make those buildings mathematically unprofitable. Regional banks, which hold a disproportionate share of commercial real estate debt, are quietly extending and pretending, rolling loans rather than forcing foreclosures that would crystallize losses on their balance sheets. The question every institutional investor is currently trying to answer is, does this unwind gradually over 5 years, or does something, a bank failure, a large fund redemption, a credit event, trigger a faster repricing? If you're buying luxury residential in 2025, you're probably fine. If you're buying office, you are either getting a generational bargain or catching a falling piano. Nobody knows which. Let's run the numbers. You buy a 50-unit luxury residential tower in Manhattan for $200 million, 30% down, $60 million of your own capital, 70% financed at 6.5%, optimistic scenario, full occupancy, average rent $15,000 per month per unit. Gross revenue, $9 million per year. Operating expenses, including management, taxes, insurance, and capex reserves, $4.5 million. Net operating income, $4.5 million. Debt service, $10.6 million. Net cash flow, negative $6.1 million per year. You are losing money every year unless the building appreciates. At a 3% annual appreciation rate, a $200 million asset gains $6 million in value per year. So you break even on paper while bleeding cash, banking on an exit in 5 to 7 years at a profit. Realistic scenario. Interest rates stay elevated. Vacancy drifts to 85%, not bad, just normal. One major capital expenditure, the elevators. $3.2 million. One bad year for the Manhattan rental market. Appreciation flat. That year, your loss is $12 million instead of $6 million. The difference between a good year and a bad year in luxury real estate, $6 million to $12 million on a $60 million equity investment. To recoup your initial investment at $6 million appreciation per year in a rising market, you need 10 consecutive good years. One recession in that window and you're extending the timeline. 2, and you're Harry Macklow. The honest summary. Luxury real estate is a fantastic business for people who already own a lot of it and can absorb bad years with cash flow from other assets. And a fairly dangerous business for people who are buying their first trophy asset with borrowed money in a city they don't understand yet, in a rate environment they've never operated in before. But look, it's your money. At least the building looks good on the way down.